Hi guys, William here, and welcome to the first episode of This Week in Crypto. Okay, so let's jump right in. We got the market update. I'm gonna give you guys a little bit of alpha, and then we're gonna go through some important dates. So the first thing we're gonna look at is the yield curve, which is just the 10-year yield minus the 2-year yield. Now, the reason that these are the two yield curves that are used is because the 10-year yield is the benchmark yield, and the 2-year yield is the yield that tracks what the Fed is doing with their monetary policy. The 2-year yield is the short end of the yield curve that is the most affected by what the Fed is doing in their trading desk. And a lot of traders use the 2-year yield to predict where the Fed funds rate is going to be. So as you can see here, the yield curve is inverted. And the reason that this is bad is because when the yield curve is inverted, all it means, since it's the 10-year minus the 2-year, is that investors are getting paid more to hold short-term treasury bonds than they are to hold long-term treasury bonds. And generally, with a longer-term bond, that requires you to take on more risk because you're going to be putting your money away for longer and your maturity date is much longer. So in order to compensate you for that risk that you're taking, you get a higher yield. However, in times of short-term economic uncertainty, the higher risk gets shifted towards the shorter end of the yield curve because people don't know what's going to happen over the next 3, 6 months, or even a year or two. So what you have is this inversion of the yield curve where the 2-year yields and the shorter-term bonds pay out more than the longer-term bonds. And that's generally not a good thing because you want to have a bond market that makes sense. And you can actually see this as we throw on the 10-year yield and the 2-year yield. So here's the 10 in orange and the 2-year yield in blue. And you can see that when the yield curve when the yield curve reverts to the upside and becomes normal or healthy, you can see a massive drop off in the 2-year yield banknote or treasury note. So that just means that things are going back to the way they should, where the 10-year yield is earning more, longer term bonds are earning more than the shorter term bonds. And you can see as it inverts, the 2-year yield quickly rises, catching up with the 10-year yield and even surpassing it like we have today. So an inverted yield curve doesn't really tell us anything that we didn't know already. When the yield curve started to invert, we knew that the economy was doing very poorly. US production and industry was falling off a cliff. People were losing their jobs left and right. Consumer spending was decreasing. You have all these things that were decreasing. The best way you can actually check on the health of the economy is to go and look at the money velocity. Now, money velocity of the M2 money supply is simply how fast a unit of currency is moved throughout the economy during a specific period of time. And as you can see, in healthy economies, you're going to have a lot of money exchanging hands between consumers and producers, buyers and sellers. But as economies weaken, you get a massive decrease in the amount of money actually being exchanged in an economy. So this likely won't have an immediate effect on the crypto markets this week. But one thing that might is the DXY. Now, the DXY is the relative strength of the dollar. Now, I've actually come to the conclusion that right now, the DXY is actually more important to look at than the 10-year yield. In my very first video, I outlined that what we need to see is a decrease in the 10-year yield in order for us to see a sustained rally in risk on assets. If you haven't watched that video yet, go make sure you watch it. However, the 10-year yield is reaching a critical point in its price history where it might find resistance and have a double top before coming down. Now, while this would be good for risk on assets, it would also be a volatile period. And while I do think that a decrease in the 10-year yield would be good for risk on assets, I actually think that the DXY is having more of a dramatic effect on risk on assets. So I think that even if the 10-year yield continues to increase, if we see the DXY continue this corrective phase, I think that we will see a rally in risk on assets. That being said, this week, if you see the 10-year yield start to come down, that would be a bullish signal. And if markets are selling off during that period of time, I would see that as a buying opportunity, not financial advice. Now, another reason I am more bullish on the markets is because there are more bullish scenarios than there are bearish scenarios in terms of the 10-year yield. The only bearish scenario that I could see happening is if we get a major increase in bond yields. Now, if this happens, the global bond system is at risk of collapsing, and I don't think that the Fed is going to allow that to happen. I think the more likely scenario is that we come up and we find resistance before coming down, or the debt market simply stabilizes, which would also be very bullish for risk on assets. The problem with an unstable debt market is that bonds are meant to be stable. They're meant to pay out a predictable amount of yield over a certain amount of time, and you're meant to get a predictable amount of yield for your bond maturity, getting paid more for longer term bonds. However, when you have this major volatility in the bond market, it worries investors. And if the bond market is unstable, then you can be certain that risk on assets are going to be very unstable as well. So while a decrease in bond yields would be bullish for risk on assets, I also believe that if the bond market simply stabilizes and finds a nice range moving forward, that risk on assets will find some breathing room and will be able to run. Looking at oil, you can see that we recently broke this downtrend line and we could be performing a bump and run before continuing higher. However, we could also find resistance here, which is a major resistance point around $90 before continuing lower. The lowest I can see oil going is around $62, where we've seen oil bottom multiple times. If we see oil continue to drop, CPI will likely be lower. Now, the energy sector itself, XLE, found support on this trend line and has continued higher. Now, one interesting thing about the energy sector is that the Cryptostackers easy bands actually work really well at finding key price points. As you can see from the pandemic low, we found resistance at the 2x long, which we eventually built support on top of. If we move this price level to the recent bottoms here, you can see that we found major support again at the 2x long. You can throw on the short levels to see where we have some major confluence in long and short levels. So we found resistance on this trend line, we broke back above this major resistance level, and now we're finding support before continuing higher. If the energy sector continues higher, which would be bad for CPI, I would expect the next target to be around 103 for XLE. But if that happens, oil will likely increase further. If oil decreases, then XLE will likely decrease as well. All right, next moving on to Bitcoin. Now, Bitcoin is king. As you can see, everybody was sleeping on Bitcoin as Bitcoin continued to break through new recent lows in Bitcoin dominance. But now Bitcoin has seen its most green day in 6 months, and it has broken this downtrend line in Bitcoin dominance. Now, if you take stablecoins out of the equation, Bitcoin dominance has not yet broken its downtrend line, and it could continue lower going into the ETH Merge if it goes well. So I would keep your eye on Bitcoin USD divided by total minus the two major stablecoins USDT and USDC. This would just give you Bitcoin dominance minus stablecoins. And as you can see, the chart is actually a little bit cleaner than Bitcoin dominance by itself. So moving on to Bitcoin's chart, we are finding resistance here on this uptrend line with some major resistance confluence coming in here with this downtrend line from the recent sell-off. Now with Bitcoin dominance so low, I would say that Bitcoin is likely to be stronger here than altcoins, but with the ETH Merge coming up, I really think that it's up to that. And I know in Cryptostackers, a lot of us actually have longs from 18.9K where we have profits locked and ready to go. And this is how we found that 18.9K level. We just took our margin pressure levels from the local high and we extrapolated a price target off of that. And as you can see, we found major confluence there with these previous tests, and we found strong support off those lows. Right now, that Bitcoin trade is up around 400%. Moving on to total cryptocurrency market cap, I actually think it's very likely that we're going to retest this downtrend line as we have been building solid support on top of this uptrend from the lows. So I think that this downtrend line will be a very key spot to reduce risk. Now this is on the linear scale, and as you can see, there is a little bit of confluence with our 21-week simple moving average with our easy bands. So this is going to be a strong resistance level that we need to break through. Back on a log scale here, so Ethereum couldn't break through its 21-week simple moving average, so it'll be interesting to see if the same thing happens to total cryptocurrency market cap. So we're on the log chart here, and I wanted to mention that if we're approaching this 21-week simple moving average and the Dixie is getting weaker and that 10-year yield is coming down or simply stabilizing, then it's more likely that we'll actually break through and we could buy on the other side of it. Now during the last bear market, whenever we retested our 21-week simple moving average, we blasted right through it and we didn't get a chance to retest it until later. Now this took us from the green easy bands all the way up to the red easy bands. If CPI comes down and the Dixie decreases in value and the debt market stabilizes, we could see something similar in today's market with total cryptocurrency market cap coming up to this red easy band level. Now the red easy band levels are decreasing a little bit, so it might be around the $1.5 to $2 trillion region in total cryptocurrency market cap when we get there. Now I talk about that investment thesis a lot more in my first video, so if you haven't seen that first video, go make sure to watch that. So those are the first things I wanted to point out to you guys for this week. The next thing that I wanted to point out was the CPI data that's coming out this week. Again, I covered this earlier. If it's lower, that's obviously better. Now on September 15th, we're gonna have the ETH Merge. This is something that everybody's looking forward to and waiting for. It's one of the biggest crypto events that we've had, and there are tons of YouTube videos explaining what the ETH Merge is and what it's supposed to do for ETH. It's not gonna require energy to secure the network. Instead, the network's consensus will be determined by stakes in the network, which is why it's called a proof of stake mechanism. So one thing I am watching with the ETH Merge coming up is the staked ETH to ETH arbitrage opportunity. Now, right now, the airdrop for proof of work is probably going to be around 2.5 to 3.5% of whatever proof of stake tokens that you have. So for easy math, let's just say you have 1 Ethereum. The proof of work airdrop that you're going to get for that 1 Ethereum is going to be around 3% of 1 ETH, or 0.03. However, as people swap out of their staked ETH positions into their Ethereum positions, we could easily see staked ETH become undervalued compared to Ethereum. If you see this arbitrage opportunity above 5 or 6%, you would theoretically be making more yield with this opportunity than you would just getting the proof of work airdrop. However, it is important to note that if you do own staked ETH, you're not going to get the proof of work airdrop, as mainnet doesn't recognize staked ETH as a valid token eligible for the proof of work airdrop. Another note is that if you do decide to take that staked ETH position, you are taking on additional counterparty risk by being involved in Lido's smart contracts. And you won't be able to switch back 1-to-1 for the proof of staked ETH until the Shanghai upgrade, somewhere between 6 and 12 months for now. So do not switch into staked ETH if you are planning on doing some short-term trading with your ETH positions. Now let's talk about Mt.Gox a little bit. So Mt.Gox was a large cryptocurrency exchange that was hacked. It once accounted for 70% of all Bitcoin transactions, and in February 2014, it was hacked. And this is when it was hacked. So users had their Bitcoin stolen from this exchange, and this was the price that it was stolen at, around $500, $600. And now the people who got their Bitcoin stolen are going to be repaid. They're not going to receive 100% of what they lost, but they're going to receive a decent chunk. And the fear is that there's going to be a massive dump on the markets due to these investors selling what they get back. After all, when they lost it, it was at around $500 or $600, and right now Bitcoin is sitting close to $20,000. So people are speculating that people are going to dump this. However, when you have something as famous as this happening, it's likely that the markets have already priced it in. However, anything's possible, and we could see Bitcoin continue to sell off further due to the creditors being repaid their Bitcoin. So there's going to be 142,000 Bitcoin returned to investors, 142,000 BCH, which is Bitcoin Cash. The majority of that portion is going to be paid out in JPY. Now, Japan is hurting right now with the JPY taking a massive crash against the US dollar. So that does make it more likely that this Bitcoin will be sold, as many of the clients of this Mt.Gox exchange were Japanese. Now, based on the 24-hour volume of Bitcoin of around $34 billion, that $3 billion in Bitcoin that will be potentially dumped, if 100% of it is dumped, could be absorbed by the volume. While it obviously would cause price to decrease, it is a good sign that volume could absorb that dump. Now, Bitcoin's market cap is around 414 billion right now, and 3 billion is a roughly 0.7% of that. So we have less than 1% of Bitcoin's tokens being dropped in the market, with a volume that exceeds the amount of Bitcoin volume that would be experienced if that Bitcoin were to be dumped. So even though we're seeing a lot of fear around this, it could definitely be worse, and it's likely that it could be priced in. So here's the Japanese yen. As you can see, it has been massively devalued against the US dollar and has decreased to levels not seen since 1998. Now, it is possible that owners of the Japanese yen will find more refuge in Bitcoin than they will in their own currency, and may decide to actually keep the Bitcoin as a hedge against their own currency. If macro continues to get worse, then the yen might actually further its decrease, especially if the Fed continues to tighten. The quantitative tightening that the Fed has been doing is what's causing the DXY to increase so much, because that strengthens our own dollar against other currencies. And other currencies aren't able to tighten as much. In fact, they might even have to continue to do quantitative easing because they don't have the world reserve currency or the petrodollar to back up their currency. So that destabilizes these countries' debt markets, which makes it difficult for these countries to tighten because a lot of their bond yields are already paying out negative rates. The next important piece of news is that the ECB actually came out and said that it's ready to provide liquidity to European banks. Now, verbatim, they said, as far as the ECB is concerned and the national central banks of the Euro system, of course, we stand by to provide liquidity to banks. So even though the energy utility firms aren't going to be getting a European bailout, they're saying that they're going to be providing liquidity to the banks, which is actually very risk on. One of the things that's causing so much turmoil in the debt markets and in risk on assets is the lack of liquidity, especially in the Eurozone. So with the ECB actually coming out and saying that they're ready to provide liquidity if it's needed, could actually spark some risk on movement. All right, so next we have the FOMC meeting. Now, I covered this in my first video, but since then the percentage has risen, and there is now a 90% chance that we're going to get a 75 basis point rate hike, which is expected considering that the 2-year yield has risen dramatically. Again, the 2-year yield rises whenever there is expected to be further rate hikes in the future. Now moving on to the specific alpha. So the Cryptostackers Discord actually just got some Nansen indicators in the information flow tab. So we now have live feeds from Nansen letting us know what's going on with the whales, so we can keep an eye on that. There is also a Nansen NFT tab giving us some popular mints that are going on. So as you may know, Nansen is a crypto insights platform that is very popular amongst crypto users and NFT users. They have a great NFT analytics platform as well as crypto. Now the cheapest option for Nansen is $89 a month with the standard platform, and prices go all the way up to $3,000 a month for the big alpha program. And now in the Discord, we have specific feeds for two specific Nansen indicators, the Nansen Wells indicator and the Nansen NFT indicator, where this will be fed directly into your Discord feed. We also have an alpha feed, which is a curated list of Twitter accounts that were flagged as high alpha accounts. Now you may be aware of Token Metrics. Their NFT sale just went live. They have not sold out. They're at almost 3,000 out of 10,000 minted, so about 30%. However, the floor price now on OpenSea has fallen below the mint price. So if you are gonna get one of these, you probably don't wanna mint it as that floor price is below mint price. Now, if we go to the activity pages, you can see what some of the lowest ones have sold for. And it doesn't look like anybody has accepted any of the offers that have been put up. Right now, the highest offer is 0.27, but I imagine you can mess around with this. And if you really want one of these Token Metrics NFTs, which give you access to the Token Metrics platform, you could make a collection offer for 0.3 or 0.35 and see if you get any takers. Personally, I did get one of these at 0.35 ETH because I was on the whitelist. And I do think that that price is fair for the platform that they provide. It's just that 0.45 ETH is pretty hefty going into the ETH Merge, where people really want a high ETH exposure. All right, guys, thanks for tuning into Cryptostackers. If you want me to keep doing these little Sunday updates for the week ahead, let me know in the comments below. If you haven't seen it already, I just put out another video today, which you can go watch right now if you want to. It's pretty short. It's only 20 minutes long. And in it, I cover why hodling and diamond hands might not always be the best idea for your portfolio management strategy. And I also cover a general overview of a portfolio management strategy that I plan on doing during the rest of this bear market and into the next bull market. Thanks for tuning in, guys. Stay safe this week. It's a big one. I'll see you later. Bye.